Hey friends, welcome to the Singapore Market Digest for Monday, May 19th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into the latest updates and stories shaping the Singapore exchange. Whether you're a long-term investor or just checking in on your favorite stocks, I've got you covered with clear, easy-to-follow insights on the day's top movers. Let's start with a quick look at the overall market. The Straits Times Index, or STI, has been showing some resilience despite mixed signals from global markets. Last week, we saw the STI hover around the 3,280 mark, with a mild dip of about 0.2% on Friday. Investors are keeping a close eye on inflation data from the US and China, which has been adding a bit of uncertainty to the region. But Singapore's blue chips remain steady, with banking and real estate stocks drawing the most attention. Now let's get into our first featured company, Frasers Centrepoint Trust, or FCT, which trades under the ticker J69U. FCT is one of Singapore's largest retail real estate investment trusts, known for owning and managing suburban malls that see plenty of daily foot traffic. On Friday, FCT's units closed at $2.19, up 1.4% for the day. This uptick came as news broke about their latest acquisition plans. Over the weekend, FCT's manager confirmed that the trust has finalized its purchase of Northpoint City's South Wing. This deal is a big step for FCT, expanding its portfolio to a total of 11 retail properties across Singapore. Northpoint City is already a familiar name for many shoppers in Yishun, and adding the South Wing gives FCT even more exposure to stable, recurring rental income from suburban retail. But how will FCT pay for this new asset? The trust has two main options on the table. First, it could issue perpetual securities, which are a bit like bonds that don't have a set maturity date. The manager has suggested an illustrative annual coupon of 4.2% if they go this route. The second option is to draw down new debt with an all-in interest rate of about 3.3%. Both choices have their pros and cons. Perpetual securities offer flexibility but come with a higher cost, while debt is cheaper but adds to the trust's leverage. FCT has already used proceeds from a recent equity fundraising to pay down some of its existing debt, which is a positive sign for investors who care about balance sheet strength. The final decision on financing will come when the acquisition is officially completed, likely in early June. For now, analysts are watching to see how this move will affect FCT's distribution per unit, which is a key metric for REIT investors. Depending on the financing mix, we could see a slight shift in dividend yields for the next quarter. Moving on to our next headline, let's talk about Synonymous Land, ticker symbol A26. Synonymous Land is a major property developer with a presence in both Singapore and Indonesia. The company's shares closed at 0.375 buys on Friday, down just a hair, but this price is significant because it matches the final takeover offer from Lion Investments. Lion Investments announced on Sunday that its offer of 0.375 per share is final and will not be increased. They've also extended the deadline for shareholders to accept the offer to June 2nd at 5:30 p.m. This revised price is 21% higher than Lion's original bid from April and stands above Synonymous Land's highest closing price in more than 6 years. For many investors, this is a rare chance to cash out at a peak price. Shareholders now have a decision to make. Do they take the cash and exit or hold out in hopes of further upside? Institutional investors seem to be leaning toward accepting the offer, given the premium in the company's recent share price history. Retail investors, on the other hand, might be tempted to wait, especially if they believe in Synonymous Land's long-term growth story in the region. With the offer set in stone and the deadline fast approaching, we'll soon see which way the majority swings. Let's switch gears to the tech sector with Creative Technology, ticker S76. Creative is a name that brings back memories for many, especially those who remember the Sound Blaster sound card revolution in the late 1980s and 1990s. The company has faced ups and downs over the years, but it's back in the spotlight after announcing a new CEO. On Friday, Creative named Freddie Sim as its new chief executive officer. Freddie is the younger brother of the late Sim Wong-Hoo, Creative's founder and a legend in the tech world. Freddie steps into the role at age 67, bringing over 40 years of experience in consumer electronics and technology. Like his brother before him, Freddie will draw a symbolic salary of just $1 a month, signaling his commitment to the company's renewal journey. Creative's interim CEO, Tan Joc Tin, will remain as executive chairman, providing continuity as the company navigates its next chapter. Investors responded positively to the news, with Creative's shares closing at 790 on Friday, up 2.3% for the day. There's growing anticipation that Creative could launch a new line of audio products targeting AI-powered devices later this year. If successful, this could help the company regain some of its former glory in a market now dominated by smart speakers and wireless audio. Looking ahead, there are a few key things to watch. For FCT investors, keep an eye out for updates on the financing decision for the Northpoint City acquisition. This will likely affect distribution yields and could set the tone for other REITs considering similar moves. Synonymous land shareholders should mark their calendars for the June 2nd deadline and weigh the pros and cons of accepting Lion's final offer. And for those following creative technology, stay tuned for any news on new product launches or strategic shifts under Freddie Sim's leadership. Before we wrap up, let's take a quick pulse check on the broader SGX market. As of this morning, the STI is holding steady, with most analysts expecting a cautious but stable week ahead. Banking stocks like DBS, OCBC, and UOB remain key drivers, while the property and tech sectors are set to see more action as the stories we discussed today unfold. That's the scoop for today's Singapore Market Digest. Whether you're tracking REITs, property developers, or tech innovators, remember that staying informed is your best investment. Always do your own research before making any decisions, and don't hesitate to dig deeper into company filings and analyst reports for the latest insights. Thanks for tuning in to the Investing Iguana. I'm Iggy, and I'll be back soon with more updates to help you navigate the SGX. Until next time, keep learning, keep investing, and have a great trading week ahead.